A benefit that these interest rates can give us is it's slowing the property market down, maybe putting prices down. So we're going to go through this inflationary period. Are they going to put them up too high? Is this world we're in, is it still a deflationary world? People get in trouble when interest rates go up. What do? I don't think interest rates are anything to be afraid of. Don't worry about interest rates. Welcome to the Passive Property Investor Podcast, where I teach you how to stop trading your time for money with property investment. I'm Jerry Parker, your property investment consultant. Let's dive in. Hello, passive property investors. Welcome to the next episode of the Passive Property Investor Podcast. Today, we're going to talk about this thing. It's been all over the internet, is interest rates. Interest rates have gone up. Why are interest rates so high? What does it mean for passive property investors? What is it doing to us? Is it important? What is it? Well, okay, why are interest rates so high right now? Because inflation is high, and the government wants to slow down inflation. They want the prices to stop going up. So they will recess the economy. That's what they're looking for. Slow down the economy to stop prices going up. Why are prices going up? Because people keep buying things and bidding the prices up. Why do they keep buying things? Well, there was a period there where the government shut down the economy, and then they printed $500 million and put it into the economy. And now everyone's got all this free money, and so they're buying stuff with it. So they've diluted the value of the Australian currency. It's kind of like if you take a bottle of vodka and put half water in it. Well, it's diluted. Well, that's what they've done to the Australian currency. And so this is why we have this inflation on us right now. And I don't think it's stopping, but does it matter? Does it matter to us as passive property investors? We're taking our equity and our cash flows and we're building assets with them. All it means is the price of money has gone higher. If interest rates are 6%, well, that's how much money costs right now. And so we want to match our cash flows as investors. So we want to have properties that have a higher return too, so we can match cash flows. And that's how we travel down the road as passive property investors and building our assets. They're going to go up in value. Inflation, obviously makes the price of our assets go up in value too. Does it make them more valuable? Not really. Not valuable. It's still a place where somebody lives. It's the same value. It's just the value of the currency has dropped. That's what's happening. So what does that mean for us? Should we wait for interest rates to come down? No. Should we worry that interest rates will erode our wealth building capacity? No. So the money costs 6 or 7% now from the bank, and the rents are going up because prices are going up too. So that will come closer to matching. But if we're losing $100, $200 a week now, that's not very much compared to the asset value. If we bought a $600,000 property and it goes up by 10%, well, that's $60,000. The little $200 a week means nothing to that. That's why it's our capital growth that we're looking for. A benefit that these interest rates can give us is it's slowing the property market down, maybe putting prices down. Maybe some of these investors that bought properties and they paid too much, or homeowners that bought properties and they borrowed too much, they need to sell at a lower price, or the natural market is just not there for sellers, and so you can get a better price and better deals on buying properties. And it doesn't affect us because we're looking at our equity, how much equity we have, how much cash flows we have, and we're deciding and looking at our risk and then deciding how much we're going to invest. And then we're investing that amount. So the interest rates doesn't matter. We're just investors, and we're just going into a market, and inflation is our friend. It makes the properties go up in price. So I wouldn't worry so much about interest rates. I would look at that as an opportunity. They won't stay up forever, and they will come down, and then you'll get more capital growth that way. So let's just talk a little bit about some recent current history and where interest rates, they're up now, but where were they before? Let's go back pre-pandemic. Before the pandemic, there was zero. Interest rates were zero for like 6 years. We had that GFC period, and they've been struggling to create demand, to create capital growth. The big fear in the economy was deflation, not inflation. That was pre-pandemic economic world. And what happened to that? We had the pandemic, and that shut down the economy, and the government's printed all this money and created this inflation artificially. But is this world we're in, is it still a deflationary world? We don't know. Economists don't know. So we're going to go through this inflationary period. They're going to put up interest rates, and they're going to fight and slow it back down. But then are they going to put them up too high? How much lower are interest rates going to go after this inflation is solved? So if we, go back pre-pandemic, it was deflation was the big fear. So there's 3 ways we can go here. That inflation is out of control and interest rates got to keep going up higher, higher, higher. Or they put up interest rates too high and then the economy slows down and then they can't get it restarted again. Or we have this little Goldilocks period where they put them up just enough and then we slowed it down and then we came to this little comfortable spot where we're going to start growing again at 3% growth. Which one is it going to be? Nobody knows. It's just, it's out of our control. So don't fear. I think the least likely would be interest rates have to go higher and higher. I don't think that's it. Since we came through a period of deflation. So I don't think interest rates are anything to be afraid of. To me, it's look at yourself, your own financial diagnosis, and find out how much you can invest and then try to match that in the property market in a growth area. People get in trouble when interest rates go up. They do. It can become a cash flow problem if it starts sucking too much of your money and you can't afford it. And why does that happen? And how do we avoid that? It's when we're doing our risk assessment about how much we can invest. The mortgage broker will tell you how much you can invest. That's not where you go to. You don't want to go to your maximum. You want to create buffers in there when you buy. And you have a spectrum of your risk profile. You might be, if you're a single parent with a job and 2 kids, you can't take as much risk. So you might need a 20% buffer or 15% buffer in what you borrow. Or maybe if you're a double income, no kids, dink, and you've got high incomes, well, maybe you can have a less of a buffer. Well, this comes into your risk profile at the beginning before you invest. And as a passive property investor, and this is, this is our methodology. This is the way we make investments. But what if this has already happened to you? What if this is the boat that you're in right now? What do you do? There's 2 things you can do. One, you can just sell the property. And maybe you won't make as much as you thought you were. Maybe you lose some money, but you're still in the game. And the lessons learned are going to be like, you took too much risk. You over borrowed. You didn't do the wrong thing by buying a property. You just over borrowed. And that was a mistake. Don't make that mistake again. You're in the game. Get back out there. Another thing you can do, it's if you do have your buffer, a risk buffer in there, you can, and this cash flow is really hurting you, you can go back to the bank and it's called capitalize your interest payments. You borrow money to cover that interest payment. And you do it until interest rates come back down, or you get the rents back up, or the problem that you had in that property that stopped the rents coming in is fixed. It's called capitalizing your interest rate. So you're using the capital as the money to cover the interest rates rather than the income. And that's it's just a fact of life. That can happen, but it's just about managing your investments as a capitalist. And this is what you do. So you either capitalize the interest rates or sell the property. Interest rates, it's just the cost of money. Remember, we're printing money. we have to go buy the money somewhere. The banks, they charge it. That's the price they charge. We try to match our cash flows on the other end, passive property investors. We can get in trouble if interest rates go too high. We got two choices: sell the property, capitalize the interest payments to get out of it. Do you buy? Yes. Properties come down because interest rates go up. It's a good time to buy. And we're not worried because we're risk-adjusted investment with the right amount that we can cover with our, risk profile. So the good news is it's a buying opportunity when interest rates go high because we are capitalists and we're seeking the lower prices in the great areas. That's what we do. Capital, like water runs downhill, always finds the best return. Thanks for tuning in to The Passive Property Investor. If you enjoyed this episode, the best way to show your support is give a 5-star review on Apple Podcasts and Spotify. Make sure you subscribe to the YouTube so you don't miss a single episode. We're on all social media platforms, so feel free to connect with me there. And if you're having specific problems making your first investment or building your portfolio, maybe you don't know which location to invest in, how much you should invest, you're worried about who to trust, reach out for me down below. I will have the answers for you. Don't hesitate. See you on the next episode.